The biggest risk sitting inside the U.S. financial system right now isn't inflation, it isn't the Fed, and it isn't even the stock market. It's a trade so boring that most professional investors couldn't explain it if you asked them at a dinner party. And that's exactly why almost nobody is watching it closely enough. It already broke once, back in March of 2020. And the only reason you probably don't remember that specific moment is because the Federal Reserve quietly stepped in with trillions of dollars to paper over the cracks before most people even noticed there was a problem in the first place. And here's the part that should actually concern you. That same trade is now roughly twice the size it was right before it broke the first time, and almost nobody outside of finance is watching it rebuild. It's called the Treasury Basis Trade. And to understand why it matters, you first need to understand the single strangest fact about the U.S. government bond market. The safest asset on earth is now being propped up by some of the most aggressively leveraged bets in the entire financial system. The U.S. Treasury market is enormous, roughly $31 trillion, and it's supposed to be boring on purpose. Governments, pension funds, and central banks buy these bonds specifically because they're not supposed to be exciting. They're supposed to be the one asset everyone can trust without thinking twice. But over the past few years, the buyers who used to soak up huge chunks of this market quietly stepped back. Foreign central banks slowed their purchases, and hedge funds moved in to fill the gap. Not because they suddenly developed patriotic feelings about U.S. debt, but because they found a way to squeeze profit out of a corner of the market nobody else particularly wanted to touch. Here's how the trade actually works. Imagine a hedge fund buys a treasury bond in the cash market, and at the exact same time, sells a treasury futures contract tied to that same bond. In theory, the price of the bond and the price of the futures contract should move in lockstep. But in practice, there's almost always a tiny gap between them, sometimes just a few basis points. On its own, that gap is barely worth noticing. Nobody gets rich off a rounding error. So to turn that sliver of a price difference into real money, funds borrow enormous amounts of cash in the repo market to buy far more bonds than their actual capital could ever support, then use that same leverage on the futures side too. Historically, this leverage has run as high as 70 to over 100 times the fund's actual money on the table. Multiply a tiny, almost invisible price gap by that much borrowed money, and suddenly you have a strategy capable of generating serious returns, as long as absolutely nothing goes wrong. And for years, mostly, nothing did. The trade grew quietly in the background, invisible to anyone who wasn't reading Federal Reserve staff papers for fun. By September of 2025, the Fed estimated basis trade positions had reached roughly $830 billion, almost double the previous peak recorded right before the pandemic. Some estimates based on gross futures exposure put the real number even higher, potentially over $1.4 trillion. Hedge funds as a whole now hold about 8% of the entire $31 trillion treasury market, financed by more than $6.6 trillion in repo and prime brokerage borrowing. Read that again. 8% of the safest asset on the planet is now being held up by leverage, not by investors who simply want to own government debt. Here's why this actually matters to you, and not just to people who read Bloomberg terminals for fun. The treasury market isn't just where the government borrows money. It's the foundation price for almost every other interest rate in the economy. Your mortgage, your car loan, the yield companies pay to borrow money to expand and hire new employees. When the treasury market functions normally, all of that machinery runs smoothly in the background, invisible, boring, exactly how it's supposed to be, and you never have to think about it once. But when it doesn't function normally, when there's a sudden shock and highly leveraged funds have to unwind these positions all at once, the effects don't stay politely contained inside a hedge fund's spreadsheet. They travel straight through the plumbing of the entire economy, and they travel fast. This isn't theoretical. It already happened. In March of 2020, as pandemic panic spread through markets, volatility spiked and repo financing suddenly got more expensive and harder to find. Basis trade funds, sitting on massive leveraged positions, were forced to unwind fast, all at the same time, dumping Treasury bonds into a market that couldn't absorb the flood. The result was something almost nobody thought was possible. The so-called safest, most liquid market in the world seized up and stopped functioning properly. The Federal Reserve had to step in with emergency, large-scale bond purchases just to stop the bleeding and restore basic order. That intervention worked. But it only worked because the Fed was willing and able to backstop a market that had briefly stopped trusting itself. And here's the uncomfortable rehook. Everything that made March 2020 possible is not only still in place today, it's roughly twice as large. Apollo's chief economist has publicly warned about exactly this scenario re-emerging, pointing out that rising rates have made the trade more attractive. Wider spreads between cash bonds and futures have made it more profitable, and repo financing has stayed easy to access, all of which has quietly pulled even more leveraged money back into the exact same corner of the market that broke 5 years ago. Regulators know this. The Fed's own research has flagged it directly. The SEC has actually mandated central clearing for most Treasury trades by the end of 2026 specifically to try to reduce this kind of systemic fragility. But mandates take time to fully implement, and leverage doesn't wait politely for new rules to catch up. So picture the mechanism one more time, stripped all the way down. A market shock hits. Doesn't even need to be a pandemic. Could be a surprise inflation print, a geopolitical shock, a sudden change in Fed policy expectations, volatility spikes, funding costs in the repo market jump. Highly leveraged basis trade positions start getting margin calls they can't easily meet. Funds are forced to sell treasuries fast, all in the same direction, into a market that isn't built to absorb that kind of one-way pressure. Yields swing violently, and because treasury yields are the base rate for nearly everything else in the economy, that shock doesn't stay contained. It ripples straight into mortgage rates, corporate borrowing costs, and stock valuations within days. Traditional financial media isn't covering this the way it deserves, because there's no dramatic villain here, no single company collapsing, no celebrity CEO to blame. It's just leverage, quietly rebuilding itself in the exact same place it broke before, inside a market most people were taught to think of as the one thing in finance that's actually boring and safe. But boring and safe were never the same thing. The real risks in markets are rarely the loud ones everyone's already worried about. They're the ones sitting quietly in plain sight, growing larger every single quarter, waiting for the one shock nobody saw coming to prove they were never as safe as everyone assumed.